A warm welcome to our guests tuning in today. We're live from the Mumu Singapore office right here for show 2 of the online series of MooFest 2023. I'm your host, Olivia Higgins. Now, while we wait for a few more people to join us, here's a video crafted and created just for you. Enjoy. Welcome back, everyone, especially the people that just joined us. Welcome, welcome. Wherever you're tuning in from, whether it's in-app, YouTube, or Facebook, we're really glad to have you here this afternoon. I'm your host, Olivia Higgins. Now, I'd like to remind you that today is all about education. Okay, it's education, it's networking, and it's about giving you the tools so that we can guide you in your personal investment journey and also help you in making better decisions in the finance space, especially going into the second half of the year. So really today is about chatting with the others in the chat box down below, wherever you're tuning in from, connecting with your community, and also you can stand a chance to win some giveaways we're having towards the end to reward you for being here with us. Okay, I'm really excited for that because you guys are so quick every time we have an engagement session for that. So be ready to learn and also be a part of this. Okay, we'll wait till the end for that. Now you're tuning in to the second show of our exciting hallmark event for the year, MooFest 2023. Now this is just a part of the online series leading up to the offline event that's happening very soon. We'll share it towards the end of the show. Let's hop right in. Now, to continue to take charge of 2023 as we transition to the second half of the year, today's topic, turning point of the US Fed hike, and what should we do as the next step? Now, how can we move forward as well in terms of strategy? But I think more importantly, we have to understand in what ways will it affect Asia Pacific. So today is really about exploring fundamental drivers within that market space and also thinking about forward-thinking strategies that you can implement into your portfolio with that. Okay, we're about to find out how you can do so and deal with uncertainty in the markets. Today with me, let's welcome from CSOP Asset Management, Head of Quantitative Investment, Wang. Hi, Wang.
Hi, Olivia. Yeah, this is E.
Hi, welcome to the show. I know it's your first time. Now, for the audience members that are new to you being an expert on here, perhaps you can give me an intro of yourself and also the objective of today's topic.
Yeah, sure. This is E. I'm coming from CSOP Asset Management. So I joined CSOP in 2016 and currently working as head of quantitative investment. Before I joined CSOP, I worked in London and for 10 years, mainly serving for the pension funds, insurance companies to design their strategic asset allocation and also sovereign funds as well. Also, I graduated from UCL with mathematics degrees and also actual science in master degrees from CAS. Probably for the audience who don't know CSOP very much, CSOP is a subsidiary of China Southern Asset Management, which is the largest and oldest five asset management companies in onshore China. So currently for CSOP, we are managing like 12 billion USD Hong Kong dollars. And what's to mention is we are the first one entering into the Singapore market as a Chinese firm. So we launched several products in Singapore market already, including fixed income, money market, and equities, and even alternative like REITs. Yeah, so we will discuss those fundamental products and link to our topics, particularly for today, and how to allocate to use those investment tools to form your investment strategy in the second half of this year, probably in the future as well. Thanks.
Absolutely. Now, before I go into the next question for you, what does quantitative investment really mean? Just to define it for the audience members that just tuned in.
Okay. For the quantitative investment department within CSOP, the department is in charge of all the ETF management. So including equities, leveraging inverse, and money market funds, fixed income ETFs as well. Currently, we are managing nearly 46 or 48 products, including Hong Kong and Singapore. So mainly what we are doing is managing those products, ETFs, including client orders, rebalance, following the order and forming the investment strategy using different instruments. For example, we get involved in equity, future, derivatives, deposits, and OTC, for example, like fixed income markets as well. So generally, that's what we do.
Thank you for highlighting that and summarizing as well. So topic today, my first question for you is, what is the US market outlook going into the second half of the year from CSOP's perspective?
Yeah, sure. If we look at the page 7, so our view, so most of the important question for this year is where's the inflation heading to? From our view, the inflation is steadily going down as people observed. Even the June data, I think the outlook for the inflation will be further down. If we come into a little bit detail, for example, second half inventory, that price is a little bit diverged from the retail market. So which means next month, probably we're expecting this part will further declining. And in general, I think we see Fed Reserve is protecting themselves a little bit by saying that there are going to be several hiking later on. However, I think that's a kind of a nature reaction compared with last year, what they are facing, because within last year, when they've been optimistic and all of a sudden inflation jump up, then they need to come back and say, oh no, we can't do like easing or remain like no more monetary policies. Then they will say, okay, for this time, I need to be a little bit cautious. Both sides can be right. But in general, for rest of the year, I don't think we are holding too much like pressure in terms of market. Generally, we do see that the monetary policy will come to norm, especially after the debt ceiling problem has been solved. The only worry I think right now on the market is whether they continue like giving pressure in terms of USD liquidity. I think the solution is out there, and currently the overnight repo has been declining and feedback to see the new issuing of the USD debt, especially for the government debt. So people worry about large issuing. Probably that's going to be a question for later next year when they have that ceiling problem again, but for short term until end of this year, I don't think it's going to be too much problem. And currently, as a summarize for US, I would say I worry too much about overheating rather than recession compared with the general view from last year. And people always talk about US recession risk and so forth. Not necessarily happening now. But regardless, from the stock perspective, the major like tech stock is driving, or seven stock is driving the stock market performance, do create a little bit concerns on the over concentrating performance, especially for the Nasdaq. If you remove those seven stocks, then you're gonna see relatively flat performance across the from YTD basis, I would say. Yeah, generally that's what we see from the US market, I think. Yeah.
Thank you for highlighting the US context, especially the
Yep.
key to mention the uncertainty element, because we expected something else last year, and now it's taken a turn of events going into 2024 as well. So, this uncertainty definition then begs the question on the flip side of the US, what about China's involvement on a macro level, and how does it come into play with whatever you just discussed? So basically what I'm asking is, in comparison, what would you say is the outlook for China going into second half of 2023?
Yeah. We don't put too much like fundamental data because that's too many. So if we look at page number 8, I think that's the only optimistic part we can comment on China economic outlook. That's regarding the de-risking, not decouple, which is happening with the US tension and outside world. So hopefully we can get some releasing in terms of a global relationship, and also that going to be a positive news for the trade and also the patent related and restriction related issues. But if we look at the table, and there's some like disappointing thing happening after reopen. So at the very beginning of this year, the two kind of trade are being very popular. One is trading the China recovery, another one is trading US recession. Then standing point of time now, half year or 6 months already passed. Then what happened is within Q1, China's economic data is looking okay. However, from April, May, and plus nearest June, the figure turning a little bit negative. And no matter it's import, export, it continue give pressure, and also the real estate, which is most important part, I think, from our understanding for the retail consumptions. Because if you look at the consumptions in terms of magnitude, ranking number 1 is property sales, and number 2, the investment, which means mutual fund investment or ETF investment. Number 3 is car sales. If you're missing the largest proportion of the consumption parts, then you need to have some kind of substitute. That's what the market generally talking about. However, in terms of fiscal policy, we don't see too much support. New projects, special like government bonds are being talked about on the market for times and times again. But the fundamental problem is nothing really happened. Then people are just trading on the news, trading on the rumors until now. We do see that China and Hong Kong becomes maybe the worst performing market compared with the global peers right now. In terms of outlook for second half, to be fair, a lot of market participants all expecting the policy need to kick in at least Q3. No matter it's monetary, you're lowering the rates, or central bank lowering the LPR, or the fiscal side, you need to spend more money and to create more demand. From our side, we holding the idea or holding the view a little bit. To be fair, is fiscal side, they facing the funding so problem. If you want to spend money, then firstly you need to raise money. Then who are gonna raise money? Very recently, I think last week or something, local government debt and local government funding vehicle becomes hotspot on the market again. Then extending debt becomes an issue, then let alone say new issuing. On monetary side, we do see some movement coming in from, I think it's in June. Then in terms of magnitude, it's quite small. Then we don't think it's gonna create too much positive factors to the market. We want to see more aggressive and more magnitude in terms of risk cutting, because from the May data and June data, we do see credit shrinking. So aggregate credit is shrinking, which is not very good news for an economy willing to expand and willing to recover. On our side, you have contradict factor as a credit shrinking, then that's very hard to the economy coming back. Then that's generally our view for the second half. In summary, is we're pending for the policy. The chance is relatively low, probably 20 or 30%. If they can engage with policy, then we probably see a very rapid ticking off, because market are waiting for this. If it becomes realized, then we're gonna revise our view again. But if nothing really happens, then I think the market generally under a bit pressure. Yeah, that's our view for the China. Yeah.
Thank you for that. So now that we've highlighted these two different markets and countries as well, in the context of uncertainty, right? Because a lot of people are always asking that question. I can't not talk about currencies for this. So how will the outlook then affect the currency side, let's say for the USD versus RMB?
Yeah, that's very hot topic recently. I think when we're preparing the slides, I think it will be lagged. Until now, I think the depreciation happening and holding on current level 7.25 a little bit. I would say there's two things drive the FX movement. Firstly is people always talking about the spread difference between interest rate. Say USD with a very high rate, then the saving rate is up to 5%, RMB is very low. So comparatively, there's more demand for the currency in terms of USD. Yeah, that's true, but it's only happens for say there's no economic outlook deviation happening, because for this year we see a lot of evidence showing that your currency performance is highly correlated with your economic outlook. So why are we saying that? Because when the RMB start to depreciate, so it only happens to May sometime and until now. So correspondingly, the spread, the interest rate spread between US and RMB is always there. It stay unchanged relatively, even though you can talk about central bank already cut the deposit rate a little bit, but 10 basis points compared with this large movement is not even comparable. So what exactly happened is the economic outlook for China changed in May and getting a little bit worsening off in June. And then the depreciation factor or depreciation pressure continues. However, the good news is very recently the central bank stepped in and they set in terms of market trading, they set a little bit higher in terms of fixing, but on the other side, they do make several you can see as an announcement or is a wording or whatever. So from the government officials saying that okay, the RMB long term going to be stabilized and so forth. So we can't use the word like intervention, but it's kind of give the signal to the market. Okay, it's too much, I think. And if you're going down too quick, then that's not good news for the RMB. Then the central bank will give more confidence to the fundamental currency. From our side, we think the outlook is you're gonna still under pressure if your economy is not coming back with momentum, or at least comparatively, your economy is not coming back with momentum. If you ask me the question of whether it's going to be further depreciation, I think maybe, yeah, maybe not, because the government official or the central bank already noticed that it's happening. But if you want to do something about it, then they have a lot of tools to control it. However, if your economy is getting even worse, or the outlook is even worse, then the pressure is always there. It's just a matter of time. You need to rectify the view to reflect the view on your currency side. Because similar story happened again. For example, last year, Japan, the export figure getting extremely worse, recording like 9 months continue losing money for Japan as an exporting country. So their currency is dropping down like no button. So it's from 130 to 140 to 145 and so forth. But after they reopen and everybody becomes optimistic, then the central bank not necessarily need to step into the market to actually spend USD and buying the Japanese yen back. And the currency is coming back with a lot of support. So even though recently I think the FX movement a little bit turning back, but what I want to say is for other currency, other economy, other currency pairs compared with USD, similar story happens. So within this year, I think the economic outlook is the driving factor. Yeah, that's our view for the USD and the CNY, I think.
Absolutely. I think you brought up some key points, like how the risks, the levels change and it's always there. And so it's always about strategizing and trying to manage these different contexts, right? And then you mentioned the case study of Japan. So that actually leads to my next question. Now, moving forward, how does it affect investors in Asia Pacific, right? I think this is something we want to look at. So I want to look at what are some potential gems are there for the markets around here that we could look at. For example, like you said, in the case of Japan, what exactly happened in that market, and how long can we expect Japanese equities to resume and move higher? So we're talking about, even the structural changes.
Yeah, of course. That's a very interesting topic, I think. Yeah, for page 11, I think as a result, the equity rally because people buy. So we see a lot of inflow into Japan market in general, and also Warren Buffett take a very strong role in that area, probably marketing to everybody on the world. But what I want to say is we see this opportunity at the very beginning of this year, even from last year end. We recommend our clients to look at Japanese market. So if we move to page 12, there are several reasons for that. So fundamental wise, people always talking about who drives the fundamental, how is the company doing and whatsoever. So within 2023, probably we see Japan reopen, then tourism and their currency being supported, and also consumptions will increase and so forth. So in next year, probably we talk about more money will be spent from the company level in terms of capex, but already happened within this year. But and also goods demand, which is a very interesting topic, is happening this year as well, because of the chips, because of AI. So, for example, Japan and Korea and other countries. So even the electricity, consumption goods demand are still weak. But on the other side, AI trends, a lot of chip demands. So the news for the US market. That's side benefit wise has impact on the Japanese market as well. So that's on the corporate side. But everybody knows. So happened to a lot of economy as well. So Japan reopen, other economy reopen, they all reopen. They all expecting more like economic activities, all expecting like private sector coming back and you need to spend more money and so forth. But our reason is for next page, for the page 13. So we look at it from top-down level. I think what when we talk about this, we need to talk about a little bit longer story for Japan. So people always know that Japan is a deflation country, and they holding extreme monetary policy, and they spend a lot of money purchasing the stocks from their own stock market, from government level, and they doing extreme QE, and they provide extreme liquidity. That's I was to mention is that Japan is the only economy on the planet doing so. So what they want is they want inflation back
Mm-hmm.
because they are facing deflation, so they don't have demands. They have like aging population, and people don't want to spend money, and the prices keep dropping down, and economic activity is getting weaker, and so forth. So the fundamental thing is that they want inflation back. However, what happened last year is the inflation coincidentally happened because of the Ukraine-Russia issue. So bring the inflation to the global level. What's to mention for Japan is their inflation is relatively low, but for the economy themselves is very moderate. So it's around like 3%, 3.3, 3.5 level. So which is a very good level for the central bank from Japan perspective. I think that's the only economy, I think, currently for the inflation wave, they feel that's a good news. So what happens for them is the economy gonna coming back. So they want the inflation back for 10 years. They start the extreme monetary policy since 2013, and they doing all the options. They buying stocks, they buying debts, they give liquidities, but not quite successful. But for this year and going forward, they're gonna implement like a salary increase and keep the inflation momentum up. Then what happens is they probably move back to a normal economy. Because if you're facing a deflation environment and you don't have nominal growth, then generally for no matter from personal level or the company level, they don't want to invest, they don't want to spend money. And if they invest, I can only get like 3%, 5% return from the company level. They're already beating the deflation environment. So most likely you're going to hear that a Japanese investor only asking for fixed income investments. I buy treasuries, and then that's okay. That's all more than enough for me. But now, if they have inflation, then they need to spend money, expand their production, and beat the inflation. Otherwise, they can't maintain the salary increase within their economy. So that's very important. They're facing different pressures. If we move to page 14, then you can see the imported price, which means the materials they're importing are getting much higher compared with normal days. Those guys are outliers over there, right? So compared with normal days, then looks fine. But for last like several months, that they saying, oh, our import pressure is there. And what they need to do is pass through the inflation pressure to their ending consumers. Then, which means they need to lift up the price. Then inflation naturally coming back. And also for the page 15, what happens to the earnings for the, probably move to next page, is we always criticize that, oh, Japanese companies, they don't want to make money, their profit margin is very low because they don't have an incentive. If they have an incentive, then they can lift it up, to be honest. They can lift up the price, they can get profit margin higher, and will cover their inflation. If you're talking about like previously, they have zero inflation and their profit level is, for example, 8%. Then today, if they want to beat the inflation, and also maintain similar profit level, then they require 11% or 12%. That which means you are talking about the mindset changing of the Japanese companies. So which is a very interesting turning point for no matter from investment perspective and also from the corporate perspective, to understand what is exactly happening. So it's a kind of a very long-term change. If the Japanese central bank or Japanese government can maintain the inflation and maintain at 2% level, 3% level, continuously in the future. And also what's to mention is the central bank is confirming a little bit that they are not being hawkish. It's not like inflation coming, I need to lift up the rate. So they're gonna maintain currently like a yield curve control, monetary policies unchanged until they say the inflation becomes long-term and steady. So the only problem for this year for Japanese market is we need to see Japanese company actually making more money and also can cover their inflation. If that trend happening, then you are talking about a fundamentally change the Japanese market if we move to number 16. So yeah, the rally is happening, but if you're talking fundamental change, then we are talking about like continuously rally. It's like a normal economy. Even you can comparable with US for long term or something like that. So I think that's a very interesting like macroeconomic story. But now everybody focusing on Japan is talking about, oh, Japan is with low valuation, so we can buy some, and also Warren Buffett is coming, so I want to follow the big guys. That if they decide to buy something, and I will follow, nothing really goes wrong. But actually, there's a lot of things happening to the economy. If you're talking about low valuation market, then there's a lot of markets with low valuation, but nothing really changed for 3 or 4 or 5 years. And this is the reason why I think we understand Japan as a market are facing a turning point right now, and people start to allocate, and especially for foreign investors. And we see the foreign investors holding a lot of shares through the trading. For example, in page 17, so we can see previously they move into future markets, but now they're allocating more. Probably next page, you can see there's a lot of allocation from the spot foreign investors, which means they spend money buying physical stocks rather than just betting on the trend by participating in the future market. So that's a fundamental change, I think. It's very interesting. So I think that's our recommendation to our clients as well. And was to closely monitoring, is that gonna really happen? If that really happening, and I think we're gonna start a new new subject or new kind of products to offer into the market. Yeah,
Very
yeah, that's our view.
one.
Yeah.
Thank you so much for delving into that as a potential gem towards the Asia Pacific investing space. I think a lot of people want to know, right? So I'm really glad that you made it very relevant for our audience as well. Now, besides Japan, we heard a lot of discussions around APAC as well, the continuous discussions like India and other ASEAN countries. So
Yes.
many are perhaps betting on this growth in Asia. So can you tell us why and what are the drivers behind that?
Yeah, it's if we look at page 18, there's two things fundamentally we need to understand why Asia, especially Southeast Asia. Because North Asia, we talk about like China, Japan, Korea, these kind of countries. Now Southeast Asia becomes a very hot topic, especially for India, for Vietnam, for Malaysia, for Indonesia, and so forth. So what happened to the economy? There's two things I think is very important. One is all related to China, actually. kind of some to some extent related to China. Firstly, we heard a lot about the supply chain changing or transfer. So as population wise, we do see a large potential. So people always talk about like, oh, Vietnam, they're taking a lot of orders, a lot of Japanese and Korean companies, especially for tech companies, start their manufacturing in Vietnam or India or other countries. And this is just one side. To be honest, a lot of Chinese companies opening new factories in Vietnam as well. So what does it mean? It means they have lower labor costs. Even there's a lot of issues being like efficiency is very low and so forth. But frankly, they are cheap. So the labor costs are relatively cheap. And people start to think about, oh, can I make more money by starting our production, manufacturing in a low cost country? Yeah, they are happening. So that's the reason why we see a foreign direct investment in those countries starting picking up. And for India, I think is for about the tech related, no matter it's iPhone or Apple relocate some productions to India, and also the tech, AI and software. That's traditionally, I think that's a very strong area within India. So after they have been doing so, what happened to those countries? So we're monitoring the trade level. If you look at the graph on the right-hand side, so they start to trading with all those leading countries in Asia, right? So no matter it's Taiwan, it's China, it's Korea or Japan or Hong Kong. So they're taking up the trade shares. Behind the scene is, for example, China, and we trade a lot with Southeast Asia countries. We have the materials we need, but we're exporting equipments or parts. They are doing the manufacturing. So they move into some kind of like supply chain. They're taking up the bottom part, and then we are doing a little bit value-added parts. And it's a restructuring of the jobs of the overall supply chain. So by nature, they being part of the global supply chain right now. And then you see a trading volume between global and especially for China, I think it has been increased by 10 times or 20 times. I can't remember exactly, but it's a significant increase. In June, I think Southeast Asia becomes the #1 trading counterparty for China. So which is a very meaningful. And then correspondingly, those guys will have more like expectation for the growth, right? So people willing to, it's just like what happened 20 years ago within China. So more foreigners coming, starting factories, investing, spend money, give jobs, and start to trade with global, and more people coming to the country. And so you have a little bit higher expectation for your living standard. And that's what exactly happened. So for page 19, so you can see the economic growth level across different countries is very relatively good compared with global level. Even from not too many countries even comparable with China, but they are getting much better compared with global general level, or also compared with like Asia level in general. Asia is, I think that's the driver of the economic growth. So we relatively holding more expectation for Southeast Asia in general, but you're still facing a lot of risk when you talk about the Southeast Asia investment. To be honest.
Thank you for highlighting the emerging markets. Now, Wang, my next question is, you brought up India as an example. I want to delve deeper into that. Now, what are your insights on this, particularly also because of its market size, its capacity, and also overall influence within Asia as a whole?
Yeah, I think India question is a little bit tricky. Why saying that? let's see page 20. So to be honest, India is very like foreign investor always like India. In 2017 or 2018, I think there's a hedge fund forum and people voting for the most attractive economy in the world. There's two economies. One is Vietnam, another one is India. That since then, of course, India market is increasing quite a lot, but it's still a very like hot, it's not very open capital market. If you want to invest in Indian local equity market, even you can see, okay, the Indian market is really for a long time, but you want to participate in terms of account opening, in terms of tax, in terms of brokerage, it's very hard, to be honest. We as a professional investor, so if you want to have Indian exposure, most likely I can go for derivatives rather than just directly enter into the country. But there are several things was to mention is they are improving. That's the reason why recently Indian become more and more like more hot topic for the foreign investors. So especially under the current phenomena or environment, AI topics, tax, and also channels, when I mentioned. So there are a lot of constraints about doing business previously. Then they are trying to easy the access, easy for the investment, simplify of their tax regime and so forth. And also one thing is being criticized a lot is their infrastructure, to be honest. If you talk about India becomes the major manufacturing country, then first question they're gonna ask is whether they have logistic support for the goods, for the products. You can manufacture that, but you can't export to all around the global. Yeah, even within India. So we do see that they making a little bit effort in terms of restructuring their infrastructures, productivities, and so forth. So a lot of economy, sorry, a lot of companies, I think, announced, as I mentioned, Apple especially, even though they announced, but relative to the investment within China, I think that's a tiny little bit. But they start to make some change. If you look at like page 21, I would say that's some detailed numbers showing from the government side. They want to encourage infrastructures and financials, the what changes they want to do. A little bit like what happened to restricted economy when they starting to releasing the constraints, restrictions. So they're gonna attract attention and make the business more attractive. Yeah, then the last point for digital side, AIs and software supports and so forth. They are traditionally, I think, attract a lot of no matter it's capitals, investment, and business projects within India. So as a company, we're using like Indian outsourcing development as well. So they becomes a global hub of outsourcing, like programming, so forth. So I think that's the reason why currently they are restricted. In summary, it's restricted, but getting releasing, so make it more friendly than given economy, given the labor cost, large population, so they become more like optimistic in terms of outlook. But we need to see what exactly happening.
Right. Thank you for that. Now, just to wrap up towards the end here, and for further discussions later, what are the overall investment implications of what we just discussed for outlook in the different markets and potential opportunities, just to summarize for the rest of 2023, Yuan?
Yeah, sure. For rest of the second half, I think if we see page 23, there are two scenarios. One, firstly, I think most likely going to be inflation coming down, and all the central banks will normalize, or would say simple words, cutting rates. So because currently all the economy are facing like quite big burden in terms of financing cost. That's going to translate into corporate burden and so forth. We do see recently a lot of emerging countries, for example, Vietnam, for example, other, I can't remember the exact name, but all those central banks are starting to lowering their rate already. So if we're talking about a more losing monetary policy environment globally, then definitely you're gonna pick up the risky asset, right? So risky assets, the most familiar is gonna be equity, and so within equity, who gonna be benefits most? I think US, Euro, Japan. If we're talking about individual countries, then Japan, as we mentioned previously, if more liquidity and if they have underlying trends, then they probably gonna attract even more money and even more liquidity from global level. And so probably we can look at Japan and also Southeast Asia equity as well. So that's gonna be better perform because currently US market, especially for Nasdaq, are performing very well. But in general, from the survey within US for most of the fund managers, the number one concern they have got is overcrowded trade within tech area. So if they are not so confident about this time's AI revolution, right? So we probably hold our bet a little bit and then probably invest in more safer area. However, there's another scenario could happen is inflation could keep current level and unchanged for much longer, which could happen because the sticky inflation is driven by the rental, the salary, and so forth. Even though we see that's cooling down a little bit from US and Euro, but it's very hard to justify whether 5% is going to be long-term norm or at least within 1 year or 2 years it's going to be holding there, which means the bank will hold the target rate even higher or higher for longer. Then which means the pressure gonna put on the risky assets. No matter from liquidity perspective, financing costs for the company, then reflect on their earning expectations. So we're gonna be safe. We're gonna start investing in something safe. Then probably money market funds, deposits, that gonna hold more shares of the investments. Singapore REITs, I think, is a very interesting area. So if the economy with more flows from outside world, but Singapore REITs are completely different from US REITs. US REITs are deep down a lot because of the demand. So you need to find demand is there and still paying your rate and paying your rental. If it's not paying your rental, then even the yields, I think for some US rates, they are marked at 20% yield or 30% yield. Sounds very scary. It's not attractive. So for Singapore, they paying you 6% or 5%. That's okay. That's a normal level. So you are not facing too much justify default or potentially not renting out events. So I think that's a two kind of scenario we foresee for later this year. And this is our view for the second half, I think. Yeah.
Perfect. Thank you, Wang, for that. So finally, perhaps the most important question of today is really where shall the active investors go next, especially for the retail side? You already mentioned the MMF, the S-REITs, and all the potentials. But I think just to wrap up our chat before we go into the application of it, what would you say is that key takeaway from your end in terms of the strategizing for the second half?
Yeah, I think the strategy standing point of time now, we already give quite a bit outlook, no matter it's a country level or economic level. So just be cautious a little bit for the second half, because for most quality trade, they already reached to certain level, and also for less the policy environment right now is getting to a turning point. So no matter is the Federal Reserve gonna cutting rates or when they're gonna cut rate, then we're gonna facing a new type of scenario. This is a kind of turning point. Then another turning point within China. So we're waiting for turning points for the policy. Whether we're gonna have any policy as a turning point, then that's guides your investment. And also for the Japan as well, there's a confirmation of the corporate earnings. That's a kind of turning point. If they can confirm that, then they can confirm next several year returns. However, in terms of products, in terms of offerings, I think the key takeaway for our products, I would say within Singapore, we do have like equity products covering like Japan, exposure, Southeast Asia, and even like S-rates and money market funds as well. And also we do have China equity and also money market funds. So if currently I would suggest we can hold on a little bit and see what exactly happened. If you have extra like savings or money to invest, don't be too rush and just waiting for the turning points actually happen. You are not missing too much because for positive like market already very high, and for turning markets, it's not gonna be like a rally within one day. So you still have time to catch up the trend. Yeah. So you can save some for money market funds or even rates, and then until the equity market signal coming back, and then you can join. You don't need to be like be the first one, I would say. Yeah.
Absolutely.
That's my takeaway, I think. Yeah.
All right, thank you, Wang, for that. Great comprehensive insights, very helpful for our users that just tuned in, also from a short-term and long-term perspective. So thank you for sharing that. I'll be back with you very shortly because I'm going to show them how they can apply what they just learned. So see you soon, Wang.
Yeah, thank you.
So you've heard the analysis, everyone. Now, how exactly can you actually access what Wang shared before? Now, I'm going to show you very, very quickly how you can do that. So I've got my phone with me and I've got the Moomoo app open. So follow through and also have your phone with you, have the Moomoo app open. Okay? Great stuff. Okay, so what you're going to do is you're going to go to the main page as you see right here, and you're going to click on Discover. Okay, very straightforward. You see funds right here. Click on funds and you can see an overall perspective of the best-selling funds at banks, the cash plus function, the trending themes. So we're talking about the different industries that you can monitor on your own based on your current investment strategy. So for the purpose of today, of course, because we have our expert from CSOP, we're going to click on cash plus. Okay, so the first tab right here, I'm on Cash Plus at the moment, and you can see the available funds right here. I mean, the Smart Safe function is to make sure that you can automate and also have something a bit more consistent if that's something you would like to explore. But if you wouldn't, you want to try it out first, you can click on this right here. So you can see USD, CSOP, USD, money market fund, click right here. And it should take you to this page. So this page is really important because it's all the data that you need to know about this particular fund. And what I like about it is that it's real-time information. It's also showing you the historical returns of this fund. You can really track it according to what you want to see it as. So if you want to adjust your time horizon and also track it according to the customized format, you can do it right here on the timeline here. And then you can proceed down to view all if you want to track the entire macro historical returns for this. If you go down further, you can also see the specific position details, and you can see the top holdings right here. You see right there, you can see what time and also the date. Usually it's just the date, but you can see how specific it is on the app. how much data you have access to as an investor. And if you want to find out more information, you just click on the arrow right here. It should take you to all the details you need to know. Okay, so that's under performance. If you go down the tabs, you can see comments. So comments is, of course, with the community. If you want to find out what people are talking about related to this fund, you can also interact with our various community users right here. You can like, comment, do anything you need. And then you tap further, it takes you to news and announcements. So if there's anything relevant to this particular fund in terms of the keyword or the key term, you'll find it right here under news. So the software is very sophisticated in the sense where there's a lot of data for you to access and also customize, okay? But I think the more important part before you decide on anything is to go to analysis. And I know we got questions on this already. You can see the different asset classes, the risk indicators related to this. And as always, click on the arrow right here to find out more details, okay? And summary, of course. So over here, it gets updated. So if there's any data related to this, it will provide you an overview of such in the fund documents, okay? So that's something you can find under summary. And over here, you can find out about the company, the investment strategy, and the specific information you need for this fund. So if you're ready, let's go back to this. You go back to the main page again for CSOP, and you click on the orange right here. So click on subscribe if you're interested in subscribing to this particular fund, and you can input your amount right here. Okay, so that's the minimum amount. And of course, you'll have to have the available funds for it before you do so. And once you're done, you can click on subscription. Okay. So it's very straightforward. Thank you for listening to that and following through, but we'll share an email towards the end if we have any more product specific questions and how to navigate the app, okay? And moving on, we're heading into our first giveaway, everyone, because I do want to wrap up the chat I had with Wang earlier, but to reward you for being here with us, we're going to do our first giveaway to our users in the Moomoo app. So here's how it works, okay? The first 5 users who answer the questions correctly, and you got to get it right. You can't answer quickly and get it wrong. You guys will get 500 points from us, and you can do this to redeem anything in the community. You know, all of this is put in place for us to reward you, but also for you to be a part of the community with us, okay? So what I'm going to do is I'm going to reveal the question. Hope you've been paying attention to the presentation. And in 3 seconds, the first question will pop up and you've got to type in your answer. Are you ready? Type in yes. Type in yes if you're ready for the first question. Okay. The first question is, what do you think reached its highest level since 1990? Is it true or false? You should know this because we did cover briefly on this. So what do you think, everyone? I'm actually going to get Wang to answer the correct answer. So type in and get it right first. True or false? Okay, looks like we've got our winners. Wang, what is the correct answer for this?
Sorry, I can't see the question.
It's no problem. I'll answer it for you. So the correct answer to everyone in the chat box is true. Congratulations, everyone. The team will be back with you. Okay. Thank you, everyone, for participating. So, Wang, I'm just going to go to the next question as an extender before we wrap up this show.
Okay.
I want to go into the Europe situation. Okay, so with the Fed hikes, rising rates environment globally, we cover Asia Pacific, we cover the US, but what is going on with the European side of things?
Europe, I think we are talking about a little bit worse compared with US market. So firstly, from inflation side, it seems it's a little bit out of control.
Mhm.
And also from economy side, uh, if we say globally, the demand is coming from US, then Europe, China, Japan, we all facing the buyer stop buying things. And then manufacturing wise, we do see a pressure from the Euro market, China manufacturing, even Japan. So doesn't matter. Doesn't matter is the stock market really strong, but the
Mhm.
economic outlook is still a little bit weak.
Mhm.
To be fair, and also recent chaos happening. So a lot of non-economic factors kicking. So uncertainty about the immigrations and politics and so forth. So I think Europe is a little bit tough, but why the stock market within Europe is relatively okay, even though we see a little bit terrible underlying market or underlying country performance. The reason being is a lot of European listed companies are global companies.
Mhm.
So you are talking about giant companies. They have the profit and they have the operation globally, within US, within China, within other countries. So they are not getting hit, particularly, for example, chaos happening in France. The France company gonna go bust. It's not necessarily in this way. So when you invest in Europe, then not necessarily just Europe,
Mhm.
then they are representing a lot of other factors, so probably which you are not quite for example, it's a BP. BP is a oil company, but they've been fined within US territory, right? So they have large operations globally that you never know. So they could be diverged from the local market expectation. Um, but in general, I think Europe is in a little bit worse position than compared with US market. Yeah, right now.
Great, thank you for that. Next question is on US equities. So what
Mm.
is the insight right now or the view on the US equity space at the moment?
At the moment, I think as I mentioned, tech is overcrowded, but you never know when whether this round of AI revolution are gonna really change the industry or the global level,
Mhm.
because uh from product, yeah, from the actual implementation level, we do
Mhm.
hear that a lot of US companies implementing their strategies, implementing their AI platforms, getting use of the solutions, and a lot of company like Microsoft, Google, there's a lot of ways kicking off in terms of application. Because when we say tech evolution, then you must have a kind of like leading app or leading usage of the technology and bring the economy or the operation or the manufacturing to next level. And
Mhm.
then a lot of people willing to pay it. Of course, then you can make money. Otherwise, is we are talking about VR, AR previously, and we are talking about like a lot of things. So people hoping that that can be an evolution, but
Mhm.
actually, maybe it's just additional things, or nothing really happens for the commercial level.
Mhm.
If something can really turning out to be commercial level you application, then that's a very exciting area. So that's generally regarding tech, but for US, as I mentioned, in general, people more worry about overheating because they are very low unemployment rates, and also the economy looking okay, because the story is they are spending money. They are they are importing countries. The demand is generally from the US balance sheet. Then they are shutting down a little bit in terms of demand and more all the demand to domestic level. Then what you're gonna see is unemployment rate is very low and high salaries. And also for the exporting countries, you're gonna see unemployment rate shoot up and also deflation happening.
Mm-hmm. Really
Yeah, so
important. Thank you.
yeah, that's a general economic like theory.
Thank you.
So that's a fundamental like what exactly happened. So within US, I think they can be okay. A lot of people worry about like US banks.
Mm-hmm.
We holding different wheels. So for large systematic important banks, you can see they reserving a lot of reserves. Actually, to be honest, for the large banks within US, they are offering very low saving rates, which means they don't need money. They
Mm-hmm.
are full of cushions. And for local, regional, smaller banks, yes, they are in trouble, and the trouble will continue. I'm not being surprised if we see more bank default, and more regional bank default, and more smaller bank defaults. Because within US, there's a lot of banks. So I think people are just holding completely different concepts of bank within
Mm-hmm.
Asia and the US. So
Right.
if you're talking about the bank default, oh, that's a quite scary things. But within US, I think people saying a lot of bank defaults. So it's not a big deal. Yeah, to be honest, it's not systematically important. As far as they have the big four banks still there.
Mm-hmm.
Yeah.
Yeah, that's an important point as well. And thank you for covering the fundamentals of that space and summarizing so well as well. So, Iwang, we're just going to pause right here for our second giveaway for our users. All
Yeah,
right. So,
sure.
everyone, you know the drill. And I just want you to focus on this question as I count to three. And you've got to answer as fast as possible, but you've got to get it right. Okay. Are you guys ready? Type in yes right now. Okay, excellent. The second giveaway question is, will the Federal Reserve raise interest rates by 25 basis or not? Is it A or is it B? Yes or no? Type in your answers right below in the chat box right now. There we go. Keep going, guys. Okay, excellent. Looks like we have our winners. Now, Iwan, what's the correct answer?
Yeah, answer is no.
Okay, congratulations to everyone out there. You will be contacted by our teams later on your giveaway prize. Thank you. Okay, last question for Ewang. Now, we're talking about the China-Japan situation just now. Like, is there a thought process? Because there's a school of thought right there that says that China may be experiencing the same pain as Japan in the last 30 years. Now, what is your opinion of this and how can we move forward?
That's a very tough question.
It's
Yeah,
a
to be
tough.
honest, yeah, so the presumably is economic, let's say putting it this way, if you have an economy and we're facing particular industry or losing momentum, there are several things you can restart the economy. Firstly is we have the price drop, the price down to boost up the demand. Because in terms of demand, it's only a matter of price. Because as I mentioned, if the property market, for example, they lower the property market price by 30% or 40%, then that's what exactly Japan happened. During the bubble, during the crisis, I think the Japanese property market in general dropped by 70%, or even more for some of the area. So what happened to them is they restructuring the whole market and create the new industry rules and restart the industry, restart the economy by smashing down the asset value, create new demands. But of course, they take a lot of efforts to restructuring all the debt. So what? Because you have the asset side down, but on another side, your debt is still there, right? So a lot of people having burden with the bank. Bank may facing unpaid debt and restructuring, and merger and acquisition happens, and that's a really long-term painful process. But what happens to the economy is they're gonna rebuild the industry and gradually restart your demand. Which I may not be very that's not be very positive within China, I think. Because if we're talking about like extremely down or even 30%, 40% cut in terms of property price, then you're gonna have the problem transferred into bank's balance sheet, and then the bank balance sheet will under pressure. So that's gonna be a lot of trouble because our financial system is solely reliant on banking system. It's not like a very open, like a capital market model. It's like a banking model. The banking model, you can't say one is right or another one is wrong, because if you have the banking model, then which means you can very effectively support the manufacturing. So which is being most important during last 10 or 20 years, right? So for China, if you want to build up a factory or build up a business or whatever, so you have the bank loans that support the economy expanding, give loans and have real assets. But on another side, you're gonna lose the capital support for the I can't say innovation, but it's more like a light asset type of industry. So that's the reason why we see a kind of imbalanced financial system right now. So if you want to challenge the support, then probably we're going to facing more severe questions if we challenge the banking system, like in terms of security. Or another way, probably you need to have like currency pressure, which is happening right now. To what extent, I don't know. So it entirely depends on to what level you want to restart the demand, or you want to gradually start the demand. Then it entirely depends on how we face the like capital outflows, foreign reserves. You need to balance out. You can't say, oh, I dropped like 50% in terms of FX, right? So that's gonna create like chaos or worries or fears in terms of the market. But if you want to be competitive and would like to grab the market share from others, make your goods more competitive, then probably lower price is another way. But also this way is really from my personal view is relatively tough as well, because as I mentioned previously, we are facing global goods demand shrinking. It's not only happens to China. It's happened to US. Sorry, it's happened to Germany. It's happened to Japan. It's happened to China. So all the exports are facing challenges. People spend less money on goods. Services they do, but goods they are being more like conservative right now. So if you want to add a shrinking market, grab more market share, make your growth happening, then you're gonna spend more money. That's for sure, right? So that's normal way to understand it. So to be honest, it's very hard, very tough. Then if we can't find solutions from outside, then we need to do something domestically. Then which means we need to lower the burden of the residents. For example, reduce the mortgage rates. At least we don't see the credit shrink.
Right.
We see the credit market stabilized. At least the burden is not impacting the day-to-day like consumption or spending level of the normal residentials or household. At least the people not repaying their mortgage beforehand, right? And for the companies, it's not like I want to shut down my company because I can't pay back the company loans or the corporate loans, right? So that's one way to do so in terms of monetary policy, in terms of fiscal policy. government probably, this is typical like anti-cycle adjustment for all the economy do. So if they facing private sector pull out, they are a bit hesitant to invest, then the government need to step in and invest, no matter it's public utilities, infrastructures, and so forth. So you need to boost up, create jobs for the employment for the general population. So that happened again and again. And as I mentioned, previously, so we've been talking about this topic again and again. So the only question is, where's the money coming from? Whether the central government want to take the burden, which means you're going to increase the central government GDP debt ratio. Sorry, debt to GDP ratio, whatever. So you're going to raise more debt. Or you rely on previous version is on local government level. Then now it's more challenging on local government. The only question is whether policy bank, central bank need to take the funding functions, or you still rely on the local government. But local government already been tough. So we don't have too much choices over there. Unless outside world has some significant change, which we don't know, probably have the impact on the solutions. But currently, that's how we see what's going on, and how can we get out, and for the future as well. So, yeah.
Wow, thank you for highlighting that. Just to end off, based on what you said, in a few sentences, for an investor in Singapore, for example, and Asia Pacific, what would you say is that final takeaway before we go into our last giveaway for everyone tuning in?
I think for Singapore investors, so you have the flexibility to invest in global assets. So you can be like, don't necessarily need to bet on high risky like opportunities. So if you do have concerns to have the, if you don't understand what's going on, then you just put your money in the safe part. And to be honest, 5% in last 10 years, you never seen, right? So so you can still park your money over there and wait until the real opportunity coming out. But because currently people, for example, US managers, even the US equity rally quite a lot. In general, active managers still underweight the equities until point of time now. I think they are even more underweight. So it's not like a bull market, we keep buying and people rush into the market. Compared to the normal like equity holding level, they are a little bit short in equity. The only reason being, firstly, because they are a little bit conservative about the current market level, and secondly, only because the cash return is very good. So they just park in there and get the 5% return. That's it.
Right.
Yeah.
Thank you so much for sharing that final takeaway. Now let's go into the last giveaway, Wang. And my question for everyone, now you know the drill. It's 3 seconds. I'll reveal the last giveaway for today, and you're going to have to answer the right answer and fastest fingers first. Are you ready, everyone? Type in yes for our final giveaway. Okay. And the question is in 3, 2, 1. How many funds has CSOP launched in Singapore? What is the answer? Is it A1, B2, or C6? What is your final answer, everyone? Okay, looks like we've got our potential winners. Now, Wang, what is the correct answer for this?
Yeah, it's a C. Yeah, 6.
Okay. Amazing. Congratulations to everyone. That was our final giveaway to end off on a high. That was Head of Quantitative Investment, Wang, with us from CSOP Asset Management. Now, Wang, thank you so much for sharing your expert insights, and we'll see you for the next show together.
Yeah, thanks for inviting.
See you soon.
Yeah.
Now, to the audience, if you'd
you.
like to watch the replay of this and other content related to funds, you can follow the MooRich page for more. This is where you're watching this show right now. But of course, you can go back because Wang shared a lot of key insights right there. You might want to look at the key replays and takeaways for yourself. And as promised earlier in the show, if you have any more questions, you can drop us an email right here. We've got 2 emails here. So if you have anything related to product or trading related inquiries, you can drop it for the first email, and then also collaboration opportunities right here. Our teams always take this seriously. So they'll get back to you as soon as they can. Now, we can't wait to share more live shows with you. So it's always moving very fast over here. We've got so much happening for you for your personal finance journey. So follow our socials over here, scan the QR code, and you'll be able to watch the replays whenever you want, and also keep up to date on visual content, as well as being a part of the community like the Telegram channels right here. And if you're also free tomorrow, tune into our 3rd show for the online series for MooFest 2023. As we lead up to the big event, we have more giveaways for you and challenges for you to stay engaged. So we'll see you tomorrow for this show. The details are stated right here. You can just sign up on the app, or you can sign up for the notifications if you're tuning in on YouTube. And if you're based in Singapore and would love to attend our flagship event for the year, so exciting. I will be there. I'll be there with other speakers as well. You'll get to see them in person on the main stage. So this is something you don't want to miss. If you want to sign up and be a part of this big event, MooFest 2023, you can sign up with the QR code right here. Hope to see you there, everyone. And as always, it was a pleasure having you with us on the live show. We'll see you tomorrow for the next one. In the meantime, it's almost the weekend. Have a good day. Once again, you're with me, Olivia Higgins.